Wait, right now, something unusual is happening in the global financial system, and almost nobody is talking about it. Over the past few years, while most investors were distracted by stocks, crypto, and interest rates, one country quietly started buying massive amounts of gold. Not small amounts, not symbolic reserves, but thousands of tons, moving through hidden channels, secret storage facilities, and state-backed institutions. That country is China. And according to several analysts and insider reports, what China is doing right now could reshape the global financial system in ways most people are not prepared for. Some believe it is simply preparation for economic uncertainty. Others believe it is part of a much larger strategy, a strategy that could slowly weaken the dominance of the US dollar and give China enormous leverage in the future global economy. And if those theories are even partially true, then what we are watching right now might be one of the biggest financial shifts of the century. Before we go deeper into this story, take a quick moment to like this video and subscribe to the channel. It really helps the algorithm push these deep investigations to more people. And if you enjoy exploring hidden economic trends, geopolitical finance, and the quiet forces shaping the future, then you're in the right place here on The Silent Collapse. To answer that, we need to understand the role gold plays in the modern financial system. Today, most international trade is conducted in US dollars. Oil, commodities, and global financial settlements are heavily tied to the dollar system. This gives the United States enormous influence over global finance. It allows Washington to impose sanctions, control financial access, and shape international economic policy. But not every country is comfortable with that system. Over the past decade, China has been gradually building alternatives. It has promoted the use of its own currency, the yuan, in international trade. It has created payment systems that operate outside traditional Western-controlled financial networks. And at the same time, it has been quietly strengthening its gold position. Gold has one unique advantage that no currency can fully replicate. It does not depend on any single government's promise. It does not rely on debt. It cannot be printed. And in times of major financial shifts, gold often becomes a foundation of trust. Some analysts believe China is preparing for a future where the global financial system becomes more fragmented, a world where multiple currencies compete for influence. In such a system, large gold reserves could provide stability and credibility to a nation's currency. There have also been whispers among financial insiders that China could eventually link the yuan more closely to gold in some form. Not necessarily a full gold standard like in the past, but perhaps a partial backing system or settlement mechanism that uses gold as a trusted asset between nations. If that happened, it could dramatically change how international trade works. But China's strategy might go even deeper than that. In 2016, China launched the Shanghai Gold Exchange's International Board, allowing foreign participants to trade gold directly within China's market infrastructure. This move created an alternative pricing center for gold outside the traditional Western hubs like London and New York. For decades, global gold prices have largely been influenced by trading activity in Western financial markets. But by expanding its own gold trading systems, China began slowly shifting some of that influence eastward. This might sound like a technical financial detail, but it has huge implications. Because whoever influences the price discovery process of gold holds significant power within the global commodity system. Over time, if more countries and investors begin trading gold through Asian markets rather than Western ones, the balance of financial influence could slowly change. And remember, China isn't doing this alone. Several emerging economies have also increased their gold purchases in recent years. Central banks around the world bought record amounts of gold during multiple recent years, signaling a broader shift in how nations are thinking about financial security. This brings us back to the core mystery. Is China simply protecting itself from economic uncertainty? Or is it quietly building the foundation for something much bigger? Some insiders claim that China sees gold not just as a reserve asset, but as a strategic tool for the future, a tool that could help stabilize its financial system if global markets face a major crisis, a tool that could support its currency if confidence in traditional systems begins to weaken. And if those scenarios ever unfold, the countries holding the largest gold reserves could find themselves in a very powerful position. But here's where the story becomes even more intriguing. Because several analysts believe the gold accumulation we can observe today might only be the visible part of the strategy. The real plan, according to some insiders, may involve a long-term restructuring of how commodities, energy, and currencies interact in global trade. Over the next few minutes, we're going to explore the evidence behind these theories, the hidden signals coming from international gold flows, and the forecasts from market analysts who believe China's strategy could eventually reshape the global financial balance. Because if the quiet gold accumulation continues at the current pace, the world may soon realize that the shift has already begun, and by the time everyone notices, it might be too late to stop it. This is exactly the kind of silent economic transformation we analyze here on The Silent Collapse, where we uncover the slow-moving forces that most headlines miss, but that could change the future of the global economy. If China's gold accumulation was only about building reserves, the story would already be important. But the deeper you look into the global gold market, the more complicated things begin to appear. Because several analysts and former financial insiders have pointed out something unusual. China is not just buying gold, it may also be quietly influencing how the gold market itself behaves. To understand this, we need to look at how the modern gold market actually works. Many people imagine gold prices being driven mainly by physical bars moving between countries. But in reality, the majority of gold trading happens on paper markets. Futures contracts, derivatives, and digital trading platforms handle volumes of gold that are sometimes dozens of times larger than the amount of physical gold that actually exists. Large financial centers like London and New York dominate the system. Institutions trade contracts representing gold ownership, often without any physical metal changing hands. These markets determine global price benchmarks that investors around the world follow. But this structure creates a strange imbalance. Because when paper trading volumes become extremely large compared to real physical gold, prices can sometimes be influenced more by financial positioning than by actual supply and demand. Several market researchers have pointed out that China seems to understand this weakness very well. Over the past decade, China has steadily expanded its presence across multiple layers of the gold ecosystem. State-backed banks became major participants in international bullion markets. Chinese trading platforms gained global access. And perhaps most importantly, China built enormous domestic infrastructure for gold storage, refining, and trading. But the most interesting developments came from people who worked inside financial institutions connected to these markets. A few years ago, a former commodities trader who had worked with Asian financial networks gave an interview that caught the attention of market analysts. He described how large institutional buyers could accumulate gold over long periods without immediately affecting prices, especially when purchases were distributed through multiple intermediaries. Instead of one central bank making huge visible purchases, gold could be bought through layers of banks, funds, and corporate structures. Each individual transaction might appear ordinary, but when combined over time, the total accumulation could be enormous. Another analyst who previously worked with international mining companies revealed something equally interesting. He claimed that Chinese entities often secured long-term supply agreements with mining operations around the world. These agreements guaranteed future gold deliveries directly to Chinese buyers before the metal ever reached open markets. If these claims are accurate, it means China is not only buying gold from existing markets, but also securing future supply pipelines years in advance. But the story becomes even more complex when we examine how gold prices behave during periods of global uncertainty. Historically, gold tends to rise sharply when investors lose confidence in financial markets. Yet there have been periods where gold prices seem strangely restrained even during major economic turmoil. Some analysts believe this happens because large financial institutions intervene in futures markets to stabilize price movements. This is where theories about market influence begin to appear. A number of independent researchers have suggested that China may sometimes take advantage of these market conditions. When gold prices remain suppressed due to heavy paper trading, it creates opportunities for long-term buyers to accumulate large quantities of physical metal at relatively lower prices. Imagine a situation where global markets focus on short-term price movements and derivatives exchanges, while a patient buyer quietly absorbs physical supply behind the scenes. Over time, that buyer could build enormous reserves without triggering a dramatic price spike. And this strategy aligns with something China has demonstrated repeatedly in other industries: patience. China's long-term economic planning often operates on timelines that extend decades into the future. Infrastructure projects, supply chains, energy systems, and financial systems are often built with long-term strategic goals rather than short-term profits. Gold could simply be another piece of that larger puzzle. Another interesting signal appeared when several countries facing geopolitical pressure began increasing gold purchases dramatically. Russia, for example, spent years building large gold reserves before global tensions escalated. Other central banks followed similar patterns, accumulating gold as protection against financial restrictions or currency instability. China watched these developments closely. Some economists now believe that gold is slowly returning as a strategic asset within international power politics. Not because countries are planning to abandon modern currencies overnight, but because gold offers something unique in times of uncertainty. It functions outside digital financial systems and cannot easily be frozen or sanctioned. For countries that worry about geopolitical pressure, that independence can be extremely valuable. There have also been reports from financial journalists who claim that Chinese policy planners regularly discuss the vulnerability of the global monetary system. The modern system depends heavily on debt expansion, central bank liquidity, and complex financial instruments. If that system ever experiences severe stress, confidence in paper assets could weaken quickly. In that scenario, physical assets like gold might suddenly become much more important. Several forecasting models from major investment banks have already begun exploring this possibility. Some projections suggest that if global monetary confidence drops significantly, gold prices could surge far beyond historical highs. And if China already holds massive quantities of gold when that happens, it would be sitting on an asset that becomes dramatically more valuable overnight. But there may also be another strategic layer to consider. China has spent years expanding trade relationships through initiatives like the Belt and Road Network. These projects connect dozens of countries across Asia, Africa, the Middle East, and Europe through infrastructure and economic partnerships. Many of these countries also rely heavily on commodities such as oil, metals, and agricultural resources. Some analysts speculate that China could eventually integrate gold into settlement systems within these trade networks. Instead of relying entirely on Western financial channels, trade partners might use alternative payment frameworks backed by commodities or gold-linked mechanisms. This would not necessarily replace existing systems immediately, but even a partial shift could gradually reduce the dominance of traditional financial centers. There's also growing discussion about central bank digital currencies, including China's digital yuan project. While the digital yuan itself is not backed by gold, some economists have suggested that future hybrid systems could combine digital currencies with commodity-backed reserves to strengthen international trust. If such systems ever appear, countries with large gold holdings would gain a significant advantage. But none of these scenarios are guaranteed. Financial systems are incredibly complex, and predicting long-term outcomes is extremely difficult. Still, the patterns emerging in the gold market are hard to ignore. China continues to import gold, domestic production continues to add supply, state-linked institutions continue expanding their role in global bullion trading, and international analysts continue debating how large China's true gold reserves might already be. Some believe China may eventually reveal much larger official reserves than currently reported. Such an announcement alone could shock global markets and instantly shift perceptions about financial power. Imagine headlines appearing overnight announcing that China holds thousands more tons of gold than previously known. Investors would immediately begin re-evaluating currency stability, commodity prices, and geopolitical financial influence. Even if no dramatic announcement happens, the gradual accumulation itself could have long-term effects, because gold markets operate on supply and demand. If a single country continues absorbing large portions of global supply year after year, eventually that pressure will influence prices. Some commodity strategists already believe that the next major gold bull market may not be driven by retail investors or short-term speculation. Instead, it could be driven by central banks quietly repositioning their reserves. And China may be leading that movement. There are even forecasts suggesting that global gold demand could reach levels never seen before if multiple countries accelerate reserve diversification away from traditional currency holdings. In that environment, gold could transform from a quiet store value into one of the most strategically important assets in the world economy. But perhaps the most fascinating part of this story is how little attention it receives in everyday financial news. Stock markets dominate headlines. Tech companies dominate investor conversations. Cryptocurrency cycles capture public excitement. Meanwhile, tons of gold continue moving quietly across borders, through vaults, refineries, and central bank reserves. And somewhere within that silent movement, a long-term strategy may already be unfolding. A strategy that could reshape global finance, not with sudden announcements, but with slow, deliberate accumulation over many years. Here on The Silent Collapse, these are exactly the kinds of hidden shifts we watch closely. Because sometimes the most powerful economic transformations happen quietly, long before the world realizes what is really changing. And if the forecasts about China's gold strategy turn out to be even partially correct, the next phase of this story could be far more dramatic than anyone expects. And this is where gold begins to play a larger role. Central banks around the world have increased gold purchases dramatically in recent years. In several recent years, global central bank gold buying reached record levels not seen in decades. Nations that once focused heavily on dollar assets began quietly adding physical gold to their reserves. China has been one of the most consistent participants in that trend. If China's real gold holdings are significantly larger than reported, it means Beijing may already hold one of the strongest strategic gold positions in the world. And that position could provide enormous flexibility during future financial turbulence. Imagine a scenario where global markets face a severe currency crisis or debt shock. Investors around the world would search for assets they believe will retain value. Gold has historically played that role during times of extreme uncertainty. If China holds massive gold reserves at that moment, it could stabilize its financial system more easily than countries relying purely on paper assets. But the consequences could extend even further. Some economists believe the global financial system is slowly moving toward a multipolar structure. Instead of one dominant reserve currency, several major economic powers may share influence. The dollar may remain important, but other currencies could gain larger roles in trade and reserves. If that transition continues, gold could become a neutral bridge between different financial systems. Nations that do not fully trust each other's currencies may rely more heavily on commodities or gold-based settlement systems. China appears to be preparing for exactly that kind of world. Through trade partnerships, infrastructure investments, and financial cooperation agreements, China has expanded economic ties with dozens of countries across multiple continents. Many of these nations are looking for ways to reduce dependence on single financial systems. Gold-backed mechanisms or commodity-linked payment frameworks could eventually become part of those alternative trade structures. Even if these systems remain limited at first, they could slowly grow over time. Every new transaction settled outside traditional currency channels slightly reduces the dominance of older financial structures. But perhaps the most important factor in all of this is time. China does not need to challenge the dollar directly in the short term. Instead, its strategy may simply involve building parallel systems that gradually gain influence as global conditions evolve. While headlines focus on short-term market fluctuations, long-term infrastructure quietly expands beneath the surface. Consider how global trade routes have shifted over the past 20 years. Consider how digital payment systems, energy partnerships, and technology supply chains have changed. These transformations did not happen overnight. They developed slowly until they became impossible to ignore. The gold strategy may follow the same pattern. One day, the world might wake up to discover that the largest gold reserves are no longer concentrated in traditional financial centers. They may instead be held by countries that spent decades quietly preparing for a different financial future. And if that moment arrives, gold prices themselves could experience dramatic shifts. Some commodity analysts already predict that gold may enter a new long-term bull cycle as central banks continue diversifying reserves. Unlike previous gold rallies driven by retail speculation, this cycle could be driven primarily by government-level demand. If multiple major economies compete to secure larger gold positions, the supply pressure could push prices far higher than most investors expect today. And remember, gold mining production grows slowly. New mines take years to develop, environmental regulations limit expansion, and easily accessible deposits become harder to find over time. This means supply cannot quickly respond to sudden demand increases. When demand rises faster than supply, prices tend to adjust dramatically. That is why some market strategists believe the true impact of central bank gold accumulation may not be fully visible yet. The effects may appear gradually, building pressure until the market reaches a tipping point. At that point, gold could once again dominate global financial conversations, the way it did during previous monetary transitions. But beyond prices, the deeper issue is influence. Whoever controls large portions of strategic assets holds powerful leverage during financial negotiations. Countries with strong commodity reserves, stable currencies, and trusted financial infrastructure often shape the rules of the global economy. If China combines massive gold reserves with expanding trade networks, growing technological capacity, and increasing financial partnerships, its position within the global system could become far stronger than many analysts predicted only a decade ago. That does not mean the United States suddenly loses influence. The U.S. still holds enormous economic power, deep capital markets, and the world's largest financial institutions. The dollar remains deeply embedded in global trade and investment. But history shows that financial leadership can evolve over time. The British pound once dominated global trade before the dollar replaced it during the 20th century. That transition did not happen overnight. It unfolded gradually across decades as economic power shifted. Some economists believe the world may now be entering another long transition period. In that environment, gold becomes more than just a metal. It becomes a strategic asset that governments use to prepare for uncertainty. And if China's accumulation continues quietly in the background, the long-term impact could eventually reshape how nations think about reserves, trade, and financial security. For ordinary investors and observers, the challenge is recognizing these slow-moving trends before they become obvious. By the time a financial shift becomes headline news, much of the positioning has already happened. That is why stories like this matter. They remind us that the global economy is not only shaped by daily market movements, it is shaped by long-term strategies, government planning, and quiet structural changes happening far from public attention. And right now, somewhere within the global gold market, those quiet changes may still be unfolding. If you found this analysis interesting, take a moment to share your thoughts in the comments. Do you believe China is preparing for a major shift in the global financial system, or is this simply a normal diversification strategy by a large economy? Your perspective adds a lot to the discussion. Also, consider sharing this video with someone who follows global markets or geopolitics. Conversations like this help more people understand the deeper forces shaping the future of finance. And if you want to keep exploring hidden economic trends, geopolitical strategies, and the silent forces that could transform the global system, make sure you stay connected with this channel. Because here on The Silent Collapse, we continue investigating the quiet developments that most headlines miss. But that could eventually change everything.